Hello traders, welcome to another global macro update. In this video we're going to go over some key news stories that are going to be shifting the markets and things that could be influencing gold, silver, S&P, as well as just information on the COVID spread, and then kind of more longer term looking at how this is going to impact the psychology of kind of the entire generation that is currently getting affected by it. So without further ado, let's just bring this over and quickly going to talk about the spread here. A huge jump. We got over 1.3 million people now with total confirmed cases, almost reaching up to 100,000 deaths here, which is obviously very negative and catastrophic. Italy's leading at 16,500. US is leading in terms of the confirmed cases by far with over 350,000. So definitely stay safe, stay indoors, wash your hands, all that stuff. I'm sure you are well aware of how you can help not only yourself, but the community around you. So yeah, not going to touch on this too much more. Just wanted to quickly go over the numbers. So this is going to be the Phase 4, another stimulus package. Let's read right into it. Phase 4 coronavirus package could pass Congress between late April and mid-May, analysts say. And I'm just moving to TikTok here because last time I did get a copyright infringement or something along the lines of that. So let's continue reading. As Washington works on its fourth legislative response to the coronavirus crisis, analysts are predicting that the next big spending deal isn't likely to be coming in a reality for weeks. So it's not happening right away, but is still in the works. The next bill is no longer sparking talk about huge outlays on infrastructure improvements, but rather it looks to set the focus on spending programs from the last package. So basically, what they're trying to do is just double down on what they've been doing, and let's dive in. The bipartisan agreement on the new package costing $1 trillion is possible between end of April and middle of May, says analysts at Beacon Policy Advisors in a note Monday. So, seems like there could be no stimulus for a little while, but they're still definitely looking to add on to the CARE Act that they implemented for the $2 trillion initially. House Speaker Nancy Pelosi said in a Saturday letter to her colleagues in the Democratic-led chamber that the next bill should extend and expand the measures in Washington's Phase 3 bill, which is offering direct payments to Americans and aid to small and large businesses. President Donald Trump signed the $2 trillion measure known as the CARE Act into law on March 27th. So this new CARES 2 is basically going to double down on what they've already done, sending direct payments to individuals and small businesses who are getting affected by this COVID-19 spread. CARE 2 must go further in assisting small businesses, including farmers, extending and strengthening unemployment benefits and giving families additional direct payments, wrote the California Democrat after pulling back on Friday from her earlier calls to include infrastructure spending in the Phase 4 bill. So people are not really interested in the infrastructure. Yes, that will create jobs, but it's more on the focus of let's just get money to people's wallets, to people's bank accounts, so they can, pay for their food, pay for hopefully their rent and other necessities that will able to kind of extend their living conditions for a little longer while they don't have a paycheck. So we can read here, we must also provide the desperately needed resources for our state and local governments, hospitals, community health centers, health systems, and health workers, as first responders and other providers are on the front lines of this crisis. I completely agree. They should be definitely getting the resources and the priority because they're the ones putting not only themselves at danger, but they're not able to see their families. They're not able to go home. It is challenging being at home, being cooped up, being indoors, not being able to do the everyday stuff that you would normally be able to do, going out with your friends, go to the bar, go outside and enjoy the day. But these healthcare workers are away from their families, away from their kids, their brother, their wife, their spouse, or whatever the case may be, and they're working and they're saving people's lives, and they're working day in, day out to help out the greater good of the community, of humanity, and that should definitely be respected for sure. Senate Majority Leader Mitch McConnell also said the upcoming bill should be a more targeted response to what we got wrong and what we didn't do enough for. And at the top of the list, there would have to be a healthcare part of it. So yeah, I definitely agree with that statement. They should be getting more than enough in order to provide them with the best amount of resources and help that they can to continue working hard for our fellow people. Right? It's a crazy time for them as well as the rest of the world, but for them especially because they're the ones dealing with it every single day. All right, now to more of kind of the global macro longer term outlook of the potential of COVID. We can see small businesses. So this is talking about rents, mortgages, all that stuff. An early poll suggests half of all businesses haven't fully paid April rent. So now that months are going by, February wasn't bad. March was when it really started amping up, and April's obviously full force into it and lockdown and really, really taking it seriously. But, people are talking summer, right? And that's multiple months of not being able to have customers, revenue, so then you won't be able to pay rent. And then that's a chain reaction, the domino effect of basically where is the debt going to, basically. So for example, if you're a small business owner, you have to pay your rent, and that owner of that real estate has to pay his mortgage. So then the bank isn't gonna. It's a chain reaction, right? So it's not just single individual businesses, but it's a chain reaction of down the line, where is it going to get affected here? And Alignable, a small business social networking company, says around 30% of the more than 1,000 respondents reported making no rent or mortgage payments in April, while 20% said they had only made a partial payment. So this is a large group of individuals here that are not able to pay their mortgage payments, and this is going to squeeze investors who are investing in these real estate development companies, REITs, as well as the banks at the end of the day, because those are the individuals providing the mortgages, and it's going to lead up to, okay, we can't pay our mortgage now, and if people are very, very leveraged up in a lot of rental properties, and they're expecting this money to just keep on flowing and it suddenly stops, you still have your other end where you have to pay your mortgage. And if you go to the bank and say, sorry, I can't pay my mortgage, what are they going to do, right? And that's not one individual, that is spread across an entire economy. So yeah, it's going to, in my opinion, turn from a COVID situation to more of a financial breakdown where banks are getting squeezed. Mortgage-backed securities are absolutely blowing up because no one's paying, or a lot of people aren't paying their mortgage. Investors are going to get scared because obviously if there's no money coming into the mortgage-backed security, that kind of basically voids an investment, really, because if there's no cash flow coming in, there's no point in owning it, right? So it's going to be a ripple effect, not just in one sector, but across an entire economy over a long period of time. And this is the delinquency rate on single-family residential mortgages booked in domestic offices, all commercial banks. And this is from Fred. This is the government website here. And we can see back in 2008, 2009, delinquency percentages were at almost 11.5%, almost 12%. And that was the worst of it in 2010, I guess, yeah. Q1 of 2010 was the worst in delinquencies. I didn't know that. I thought it was going to be worse in 2009. But 2010 was the absolutely worst. And this is only in quarters, so we're not seeing any change right now. But what's going to be very significant is, in my opinion, Q2 and Q3 are going to be very, very challenging times. And we'll see how the delinquencies are doing it in the percentage of them, and if they're increasing, that means banks are getting squeezed because now they no longer have the asset, right? When you create credit, someone is thinking they have an asset because there's payments coming in, but if that asset evaporates and the credit's gone, you no longer have that asset if a person fails to pay those mortgage payments. So it's going to create a ripple effect throughout the whole economy if this does get worse. But I just wanted to say that we are not going to be biased, but we also are going to tell the truth, and it's it's not looking phenomenal. I don't really know how to put it in a positive way. So this is the last thing we're going to talk about before we get really deep into the charts, looking at a bunch of different asset classes. Coronavirus could create a generation of super savers and reshape the economy. So just wanted to touch on this. We're not going to go into the blog post or anything, but just the idea of this definitely makes sense. If you recently started business, got fired, and are really having financial troubles, especially if you are in your 20s, early 30s, when you're supposed to be making leaps and bounds in your career and trying to get ahead, and you're getting absolutely demolished by this, you're going to have a different mindset coming out of this economic difficulty or economic situation that we're having right now with COVID. You are going to be coming out with it of more of a let's save for a rainy day mentality instead of let's spend and let's be consumers like a good little American like I am, because that's what the government wants. That's what central banks and basically everyone works off. Consumerism is good. It keeps the economic machine going where people spend money, they borrow, they create more money through credit. It is how the economic cycle works well in the eyes of many Americans. And having a generation of super savers is extremely deflationary. It will reduce the velocity of money substantially, because if you're not spending money, and if an entire generation is not spending money and stuffing it within their mattresses, or even worse, taking it out of banks and then storing the actual cash, that's extremely deflationary. And central banks do not like that. They like a steady, slow inflation, and deflation is not a good thing in their eyes. So what are they going to do? They're going to overreact, like we've been talking, right? What would they do? Okay, well, an entire generation is not saving. What do? You give them a shit ton of printed money and hope that they're going to spend it. And then the economic cycle would turn, the gears start getting lubrication because of the increased spending of money, or currency, I should say, not money. And then that is hopefully, in their eyes, the way of getting out of this deflationary spiral. Japan has done it, in their worst times. I don't exactly know when, but they gave money just to young individuals, so they would spend it and create the economic lubrication to kind of continue the operations. And it looks like they might be doing that as well, because we've already said that their phase 4 is going to have more stimulus, more paychecks going into bank accounts, and then with a generation of super savers, it could just be this on steroids in the future. I don't know how far, but we could be seeing massive checks in, because the government is saying we need people to spend money. We need consumption to start again, because that is going to be the driver of GDP. Buying things, selling things, money exchanging hands, that is economics, and that is when you see an increase of that, that is positive economics. There's more people spending, there's more people working, there's more people earning, there's more people getting a paycheck, more money being exchanged. That's positive, right? And when you see everyone just hunker down and hoard all their cash and save and don't spend any money, that is a nightmare for central banks. And the way that they are going to combat that is to give people money to spend. Basically is my view. So not going to dive into that anymore. Hopefully you got a good understanding of what our view is in terms of where it could go, what central banks could be possibly coming up with to try to mitigate the deflationary spiral that we are going to go into, or that we're currently already going into right now. With asset prices going down, we are seeing deflation. CPI numbers are going down, which is consumer price index, which is a good thing to look at for inflation, because it's like the value of a certain amount of goods purchased at a grocery store. So then if the value goes down, it costs less for the same amount of goods. If the value goes up, it costs more for the value of goods. And it's a CPI. It's a great thing for understanding inflation. But yeah, that is the fundamental aspect of the video complete. Hopefully you enjoyed it. Just letting you know, if you do have any questions involving the news articles we went over, anything that I talked about, anything that I touched on, definitely please put it in the comments and I'll be sure to go over it at the end of the video. And we're now going to get into our charts here. First thing we're going to go over is gold, silver, and quickly talking about the gold and silver ratio, not really. And then we're going to end off the commodities looking at WTI Crude Oil. And then we're going to go into the indexes looking at the SPX or the S&P 500, looking at both long-term and, or I guess, the daily chart and the 1 hour / 4 hour chart, looking at smaller term and longer term time frames. And then we'll finish it off looking at the US dollar, which is going to be the strength of the dollar, and it did get a little bit of a bump up. So first off, let's now go to gold. All right, I'm going to get a little bit of coffee and then we'll jump right into the charts here. All right, so first things first, let's get our charts here. And we should go to the long-term time frame first. I'm going to do that. Before jumping right into the charts, I just want to talk about the longer-term time frame, and then we'll jump in the 4 hour. I know we talked about it recently, but it's a Monday, and it's a good thing to go over what happened last week and what we could be seeing here. So last week, we didn't have this big green bar, so this was actually like this, and what we saw is a high and a lower high. So we connected the lower highs here, and on the 4 hour, it actually looked pretty good because the second connection had multiple touch points against the resistance, so it looked pretty well respected all throughout the chart. And also, we weren't seeing a whole lot of inflation. The stimulus package brought the S&P up, and usually when you see the S&P go up and people become more bullish on the stock market, gold is necessarily not really super bullish at that point. It's when there's more fear of the stock market and the currencies devaluing is when you really start to see gold do well. But at this point, it shot up past the previous high, which is going to be right here. So it made a higher high. So as of this moment right now, this is a low, this is a high, this is a higher low, and now we're creating a higher high from our key level of market structure, which is going to be right here. So at this point right now, we are actually more bullish than bearish, although we are right below the $1,700 level of resistance, which in my opinion is going to be something that I want to see the price pass before I look to enter long. And that's the overall structure of the daily is I have a key level of resistance around $1,700, major structural low at $1,450, and this is the zone we're currently playing with. I did draw a descending zone, but it broke above, and now, in my opinion, we have a pretty high likely chance that we're going to be testing 1,700, and it's just a matter of if we're going to break this resistance, make a higher high, and then test for a higher low. That would be super bullish, and I would be looking to potentially enter long, but as long as it's below the $1,700 zone, I don't really want to be looking for a long just yet. I would rather wait to see the price break this zone, break this key level of resistance before I look to take any longs, just because I have a higher dependability and a higher probability of the price moving upwards if I've already broken the high and respected it as a valid level of support. It just, to me, has a higher probability of it continuing towards the upside than if I enter right here at a key level of resistance, not just once but twice, right at the $1,700 zone, and we've already seen the sellers reject the price twice off it, and we're right below it now. So in my opinion, it does look a little bit more bullish, but I'm just going to take the approach of being a little bit more conservative because we're in a very volatile time. You know, they could just put in another stimulus package and holy shit, the stock market's up and then gold's down again. Like, it's at this point in time, there's a lot of fundamental catalysts, factors that play into it, and that's why we do try to do our fundamental news first, discussing, you know, stimulus packages and potential things that could affect the markets. But yeah, at the end of the day, we are going to stay back and stay patient and look for a better opportunity to enter in this market, because in my opinion, gold doesn't serve as a trade that really gives me any edge at the moment. So if you don't have an edge, don't put any trades. Simple as that. Yeah, Truck Knobs, 3:45 Mountain Time Zone and still drinking coffee. Yeah, I drink a lot of coffee. Not like a ton, but a decent amount for sure. All right, so let's now go on to the smaller time frames. This is now the 4-hour chart, so we're going to get a little bit more granular of the detail that we're going into in the price action, but this is very important. So the 4-hour chart, we see that resistance, which is going to be red at 1700. This is going to be the main level of supply. So in my view, we're pretty close to it, so I don't really want to be looking for a long. So right now, we got a resistance right here, we have an ascending support right here, and we have a descending support right here. So we are within this big triangle. Let's get our line. So we're now within this zone. In my opinion, this is kind of like a no trade zone. I don't really want to be trading in this range. Actually, it should be red theoretically. But as we can see, I don't really want to be trading in this range because there's a lot of zones that are close, but there's nothing really broken. And there's just a lot of noise that, in my opinion, it's going to happen around here. So I don't really want to be any part of it unless it's going to give me a better opportunity somewhere else. So that's my first bias that I have within this current market structure. Now, what I would be looking for a potential entry possibility is if we hold this resistance at 1700 and then come up, and then we are able to break this ascending zone. We see as an anchor point right here, we see our first touch point, we see our second touch point, we see our third touch point right here when it broke the descending zone, which was our squeeze, and then we shot up, breaking the squeeze. The bulls were able to win the battle where the price was really at the apex, and it won the battle. The bulls took over the market, really shot up the price, breaking the market structure high, which was right here. Would not be too surprised if we retest this zone as a new level of support and then make our way back up to the $1,700 zone. So as of right now, we broke, made a significant market structure higher high, breaking this zone. So we could be seeing a higher low, which would be back retesting the 1650 level of support. And then I wouldn't be too surprised if then we continued the momentum to the upside, hitting the $1,700 zone like so. So for the near term, that could be a possibility, and I'll be somewhat looking out for that. But like I said before, within this range is not really a trade area that I really want to be looking for. It's when we either break to the downside here and we fail to hold this ascending zone that I'd be looking for a potential short to the downside. But then if that is the case, I'd look for silver for more of a short, and we discussed that within previous videos. And then a long would be if we break this resistance zone right here and test for a higher high and break it and hold that higher high above 1700, and then we retest this zone to form a new support from the previous level of resistance. Because the market structure is already up. This is a low, this is a higher, this is a high, sorry, this is a high, this is a low, this is a higher high, this is a higher low. We're seeing a test of the higher high again, which is going to test the $1,700 zone, which is a main level of supply, and then we're probably going to enter into a higher low than what we saw right here, and then we're going to go right into the apex of the pattern, which is going to be right here. And it's just a matter of, if we break to the upside, we're going to be looking for longs once we retest the previous resistance as a new level of support, or if we break to the downside, classic ascending triangle pattern, breaking the support, and we're probably going to be looking for some short opportunities within the asset class, meaning precious metals. But I think if gold starts to go down, we're going to look for silver for a short, because silver looks more bearish. On the weekly, we're making lower highs. For silver, we're making higher lows. So looking at the weekly chart, silver looks more bearish. So then if we see gold start to fall and it looks bearish, we're instantly going to go to silver and say this is a better asset to trade on the downside. And then if it looks bullish, gold is the asset to look on the upside, in my personal view, until you start to see the speculation of precious metals increase, aka gold and silver ratio going down. Right now it's in like 120 or whatever, highest point in a very long time. Once you see the gold and silver ratio go down significantly, it's going to tell you that there's a lot more speculation in the precious metals market, and that's when you'll start to see silver go up substantially compared to gold. But as of right now, gold is going to be bullish, silver is going to be a little bit more bearish as a directional bias viewpoint. So hopefully I gave you some insights on gold. We got two options, and I described both of them. Right now, I'm not really looking to take any trades right now. I just don't feel like I have the highest probabilities to look for a trade that has edge other than the retest right here. So this could be an option where we have a pullback to around 1643 maybe, and then we have a stop loss at maybe at 2%, and then you're looking at your first, maybe a little bit higher, because I would like to have a risk reward of 2, maybe somewhere like that. So if it does pull back to our previous zone of confluence, like so, probably a high probability chance. If it holds this zone, you don't want to enter right away. You want to wait until there's 2-3 injections of buy pressure on a 1 hour chart, depending on what time frame. Maybe 15 if you're taking smaller time frames, double bottoms, some level of a base hold where you see buy injections coming into the market. Then you're like, okay, A, it's a zone of confluence where I know there's a potential for high probability of buy pressures in the market, and B, I'm actually seeing the buyers enter the market. And C, look at the volume. Yes, you are seeing decreasing buy volume, but look at the discrepancy between the buyers and sellers in the market. There's literally almost no sellers compared to the amount of buyers within the market, especially where you should be seeing sell pressure. Previous level of resistance there, at that same level of resistance, you're seeing no supply candles, meaning there's a lack of supply, meaning that the demand is going to overtake the confidence, aka price appreciates. So it looks more bullish, but as of right now, it made a strong impulse move to the upside, breaking a resistance. And we don't like to enter at the completion of impulses. We like to enter at the completion of exhaustions, which is the end of a pullback. So in my opinion, the pullback that you would want to enter for the highest probability situation would be around 1635-ish. And then once you see that validation of a support, that would be a pretty high probability situation that we could capture a small move, something like this. But at the end of the day, in my opinion, this is still a lower risk situation until we get a breakout that is on a larger time frame, like the two that we've described, either to the upside or to the downside. So yeah, that's going to be my view of gold. Hopefully you got something out of it. If you have any questions, definitely drop it in the comments below. Next chart we're going to go into is silver. So this is that weekly chart, right, that we were talking about. See these lower highs form, and then it breaks the support, which is right around here. And yes, it did pull back, validating it, and it has poked its head above the previous support, which is a new resistance. But at the end of the day, I'm not going to say it's a breakout yet, because this is a zone, not an exact price area, or price line, I should say. So I'm going to be a little bit more bearish on silver. I don't really have any actionable trades for silver and gold as of right now, but it's still in the works in terms of opportunities. And if it does exponentially go up, hey, that's great. If we do see gold and silver take the quote safe haven asset characteristic that people perceive it as to be, which it is, over 5,000 years, it's been a safe haven asset. So there's a very high probability that we're going to continue to see those same properties, have those same attributes, aka gold and silver being a safe haven asset. So yeah, we're probably going to see that. But as of right now, in my opinion, it's still too early. I think the US dollar is still going to be the short-term safe haven assets for investors, as the second wave of sell pressure in the equities will come, and then more people will sell stocks, which then means more people are buying US dollars, right? If you're selling any stock, any US stock ever, you are buying US dollars, right? Because it's a pair. Equities are pairs. You're pairing it with the US dollar. Same as Forex, same as crypto, but you don't pair it with the US dollar because it's already paired. Same as gold, oil, silver, all paired with the US dollar. It's a world reserve currency. So a lot of people that are selling assets are going to go into the US dollar, and that's why it's seeing so much buy pressure right now, and that's why it's regarded as the quote safe haven asset for the short term. But in my view, the central banks are going to overreact. There is going to be worrying concern for inflation, and that is when cryptocurrencies are really going to be have the shine light, or the light shine, or it's going to have the pedestal of the fixed supply asset that does not get affected by central banks printing money into oblivion, right? That is your hedge against that. Yeah, right now I don't see it in just terms of fundamentals, but in terms of the charts as well. I don't really see strong pushes, and if we do see a strong push in gold and right here, but if we are going to see this huge monetary shift where fiat currencies are going to get printed a shit ton, gold's going to go way up. So there's going to be a lot more opportunity. You don't need to catch the very, very, very bottom, right? It's not mandatory. It's just catching the meat of the move is going to be awesome in itself. So, you know, if you're an investor averaging in gold and silver, I think it's a phenomenal idea. Obviously, I'm not a financial advisor, but I think the shift is slowly happening. Not yet. It's still too early. I think that investors are definitely still thinking that the US dollar is still a huge safe haven for them right now still. But as time goes on, I do think that psychological shift will occur. But right now, still too early, so I'm not super bullish on gold, silver, and crypto just yet. In the long term, 100%. But in the short term, I think there's a little bit more deflation that has to occur before we get our surge and buy pressure for those safe haven attributes that gold, silver, and crypto share. So not much more to talk about on gold. Here's the 4-hour chart. We do see that it's holding an ascending zone, which is nice to see. We do see the resistance at around $15, maybe $14.50 as well, around that range, key level of supply. And we also see in confluence this descending zone that actually broke. So if our fundamentals were more bullish in my view, if we saw CPI numbers increase substantially and the inflation go up, this would be pretty damn bullish, especially if we break the previous high right here and the previous high right here. That'd be pretty darn bullish in my view, but I'm going to be a little bit more hesitant because of the fact of this major $15 resistance that we've been talking about for a long time. So that's my view. Yeah, I'm a little skeptical of a huge bull run just yet, but if it breaks 1700 and if it clears $15 without any worry and we see it go way above that, I will have to shift my bias on. I'm not going to have my bias forever, but as of right now, I'm still not convinced from the price action that we're really going to start to see that momentum to the upside with a series of strong higher highs and higher lows take the market upwards. So that's just my view. Gold and silver ratio just holding at around 110, went all the way up to 126, but now we're just consolidating sideways, and if we see it drop, that means silver is going to be appreciating faster than gold. But right now we're consolidating. All right, so crude oil, something to talk about. Last week was a huge move for U.S. oil here. Absolutely exploded. Trump said that he was going to talk to OPEC and Russia and try to get a deal for them or discuss supply, but I just think that's news. And to be completely honest, I do think that this is a pullback where there was a massive short squeeze. Look how far the price just got beaten down, right? It hasn't really formed any real pullback. That was a pullback here, but it got slammed right back down, and then it formed a base, and then this was the short squeeze. And you got a short squeeze up, and then you hit a key level of support, previous level of support, new level of resistance at around $28, and that's where we currently are right now. So what could we see from this point onwards? I'm not huge into the oil sector, to be completely honest. I've somewhat recently within this year started looking more into trading oil, but I like to look at more gold and silver personally. But let's continue on with the analysis. We do have that key level of around $28, which the price is currently holding right now below. Would not be too surprising if we do actually break that zone and get to $36-ish, which would be where the gap is. And then at that point, we'd probably be looking for some ascending trend lines to then short, because I do think that there is more bearish potential for the oil market. But just in terms of technicals, we're just seeing a nice little pullback here. We got a nice little squeeze right here and another solid push to the upside. We're probably going to see some level of an ascending zone get created, and it's just a matter of if we're going to break that zone or not. But as of right now, it's still very early in the structure of the bullish push. We see a nice little zone right around here, creating a previous resistance into a new level of support right around there. So around $24 is the current level of support. We can see previous level of resistance back in March, which is now a resistance support now in April. So we're currently sitting at $24 as a minor level of support, and then $28 is the mid-range zone that we have within the major structure that we're currently in. And then if we do break that 28, high probability that we're probably going to be going all the way to 34, if not a little bit higher, 36, 38. But that's my view of oil in the long-term picture. Like I said before, I do think we're probably going to come back down to some degree, and then we have a good edge trading breakouts that are to the downside after the price has made a pullback, like we can potentially see here. And that's what we're going to be looking for the S&P as well. But for now, we're not really looking at trading. There's not really an opportunity that I see on US oil right now, to be completely honest. It's kind of in a mid-range zone, not really able to trade, and there's no real indications of sell pressure. If we did get another push to the upside and then we double top and then broke down with a huge bearish engulfing candle, then pull back with a weak bullish candle, testing the previous support as a new level of resistance. If we're seeing some sort of weakness and a validation of sellers, this $28 zone could just be the pullback. If we do put in our fib here, let's just get our fib and look at fib retracement. So this is the high, and then we can see the low being right there. And just to make sure, let's always zoom right in, get that candle closure on the 4-hour, significant zone, candle closure on the 4-hour, significant zone. And we can see right here, the price is basically right at the 618 fib retracement level, which is a very significant zone that we're also using for our S&P 500 trade. So yeah, would not be surprised if we do hold this zone, but as of right now, it's still too early to short. And you're probably thinking, okay, what would we need in order to look for a short in this trade? Because we've did our fib and all that stuff, we know that 618 and 50 is around here. So there's going to be some level of sell pressure because that's a key level on the retracement. So what are we looking for in my personal view? We got one key low right here, one key low right here. I wouldn't be surprised if we go like this. Zooming on the smaller time frame, it's going to be a large symmetrical triangle like so, and it's just a matter, like it's going to be like this, but this is, for example, a zoomed out version of this, and we have an edge trading this setup, right? We formed a high here, so it went like this, and it went higher, and then now we're forming weakness. We could get one more weakness, and then you usually form a pretty bearish candle right here, pretty bearish engulfing candle right here, and then you get these trickles that are slowly coming up, and then you're looking for a previous support, new level of resistance, all this stuff, all our confluence, VSA as well, and then you're looking for the bearish moves. So kind of something like this would not be surprising, and then you get a little high up, and you break, a little pullback, retesting previous support and new level of resistance, forming a lower high, creating the lower low, lower high structure to the downside, and that could be something that you'd be looking for there. Yeah, we do have edge trading potential reversals, and it forms an ascending zone, head and shoulders, or reverse head and shoulders, and descending zones for reversals from the downside to the upside. So kind of like we saw here, descending zone, you formed a very, very strong level of support. You broke, pulled back, and then once you break the market structure, which should be this high here, that would be the market structure break. That would be very significant, that we would have definitely our eyebrows raised. Looking at the 1 hour, not much more to talk about. Let's just draw it in right here. That's probably not the same zone. Kind of like that. That could be an option. And then we see it as a previous resistance turning into support. Let's make it a little bit bigger. Sort of like so. So then we see a push up, pull back, push, pull back, push, pull back. So then I'm sure you know what you were looking for, push, pull back, and then the momentum to the downside may start. So right now, definitely not something that is ready to take a trade yet, but yeah, it could be something that could be a good opportunity to make that extension to at least retest the $20 range to form that base and the consolidation sideways. If not, make another move to the downside, breaking that base, and then we're probably getting a lot of a pretty aggressive momentum shift here, because I'm sure there's a lot of people buying here because they're thinking it can't go lower, and that's pretty dangerous words within the markets. It can't go higher, it can't go lower. Yeah, just look at Tesla. If you're shorting, just look at some of these cannabis companies if you are long. Yeah, they're brutal. Or some of the alts, right? Absolutely. Look at Ripple. You could have bought it at plus $3 and now it's at like 16 cents, right? So it can always go lower. It can always go higher. Always look at the price action, not the exact price, because price action will give you more information than saying, oh, it's at $100. It must be a good buy. My personal opinion. Not a fact, just my view. All right, so now looking at the SPX. This is the SPX 500 USD, which is the basically the S&P 500, the largest 500 companies in the world. But this is, for me, the contract for difference, or CFDs, which will provide less gaps. And basically, I'm trading contracts instead of the actual share. I can trade half a share, quarter of a share, 1.5, and I can leverage and all that stuff. So more freedom, basically, when I'm trading. But it's more or less for swing traders and day traders. But anyways, let's get right into it. Actually, before we get into the 4-hour, let's get right into the daily first, because that is pretty important, and we are using our fibs. What did we say? We do want to see that pullback to around the 50% retracement or the 618. Around there, that is when we're really looking to enter our short position. Oh, excuse me. Because we already did all our back testing in the previous 2001 dot-com crash and 2008, and we came to the conclusion that the highest probability situation for us to enter short would be to find and be patient and wait for the pullback to around the 50% to 618 retracement level, where then we would look for this to serve as a key level of resistance, where we would get some reversal pattern. We would get an ascending triangle forming higher lows. When we break the series of higher lows, we'd be looking for shorts. We also saw a head and shoulders where we broke the neckline, and then we got a strong push to the downside, continuing our next leg to the downside. So yeah, definitely looks like we got some waiting to do. It looks like, it could push the upside here, but there is no way in hell that we think that we're thinking that it's the bottom. We are very interested in shorting for the next leg down, and that's going to be our bias. I do not think that this is the low, and we're going to bounce back. And for the people that are calling me super negative potentially because I do think that, you got to look at history. I'm not negative in thinking that I'm bearish because I want the economy to fail. Not at all. I'm just analyzing what I see and then trying to provide opportunities for myself and the people who are watching this video and Performante as a brand. And, if it's making money to the upside because we're longing something, or if it's making money to the downside because we're shorting it, in my opinion, it does not matter at all which way it goes. It's just a matter of how probable the situation is going to be and betting on that outcome. So yeah, basically, in my view, I do think that there's going to be two more major legs. One, which is going to be, I don't exactly know when, but I do hope that the price is going to go up a little bit, and this is going to entice a lot of retail traders thinking that that's the bottom. Like, you see people who have a large following, like Jim Cramer, say betting against the stock market, aka shorting, is betting against science, and making it seem like shorting is this instrument that no one should use because everyone should be permabulls, because economic growth should only be in one direction, straight up. And there can be no corrections, which is not true at all. Like anything, there has to be seasons. Look at seasons in the world, right? There's winter, which is cold. It's less sunshine. People say it's a little bit more depressing. There's snow. It's cold. You gotta bundle up and it's cozy, but it's less, what you could say, I guess, happy, unless you're like a snowboarder or something, but it's less like happy and joyful than spring or summer, when things are blooming and there's life everywhere, the sun's shining, it's warm, the grass is super green. There's ups and downs in any cycle, business cycles, seasons, personal life. If your life is a straight line trajectory, that's pretty boring. You're not going to know the highs and how happy you are, how thankful you are that you have food on the table, or it's someone that you love very much who cares about you, or you're able to provide for yourself, or you got out of anything, like typical situations, whatever they could be. But you see the cycles and you see the downs, and then you get out of it, and then you get the highs, and you look back and reflect and go, wow, I really got myself out of that one. And that builds character, and that builds self-respect, because you see the shit you went through and you're like, wow, that really made me a lot stronger than I would have been if I didn't go through that at all. And what a lot of people are hoping is there's just no economic downturn. There's zero. And that's impossible, right? And, with these permabulls saying, this is the bottom, look at 2001, look at 2008, and see how they went down. It is a lot more clear looking at the weekly and daily chart, looking at 2001 and 2008, and really just sticking back and just looking at the chart instead of going every day and listening to people say it's bullish, it's bearish, it's bullish, it's bearish, and confusing your brain, because it's very difficult right now. People saying the coronavirus, the entire pandemic is now priced into the stock market. Like you're gonna believe that. Like, I personally have no hope that it's priced in right now, even at these prices, in my personal view. There's 10 million people that applied for unemployment within the first month of March, or like 2 weeks or something like that. But 10 million people, right? That's like more than 3% of the entire fucking population of the United States in such a short amount of time. Completely wiped out from the economic workforce. That's substantial. That's not something to just bounce back from, in my personal opinion. So, I do think it's going to get worse. And that provides an opportunity for people, for those who are not very active in the markets. If you're just holding 401ks and doing absolutely nothing other than just sitting at home and having no involvement in any financial markets, it's just going to suck, because you're going to lose value in your assets if you're just holding your 401k or long-term investments. But if you're more active in the markets, this provides a tremendous opportunity, because let's say it takes like 5 years to invest from, let's say $100 to $150, right? Let's say a long time, right? In that same distance, to get from $150 back to $100, it could take maybe, 4 months, 6 months. So the amount of, volatility, it's more risky, 100%. It's way more risky. But the amount of opportunity that is available in these volatile markets is in such a compressed amount of time that you're able to escalate your net worth, your portfolio value, your social standing, if you're really looking at it in that terms, quite quickly, because you see these massive shifts. So, this is the first one. I do think there's going to be 2 more. And looking at, TVX that can go from $200 to $1,000 in like 2 weeks, or shorting this, looking at how far it went down, looking at the risk reward parameters that you're looking for in these trades, you're able to provide some awesome opportunities. Trucknub says, lol, at the moment I've made more money shorting than going long. See, like the opportunities are there, and if you have been putting in the time to understand basic TA, understand basic risk management. Not saying, I'm going to short this and I have no idea when you're getting out. No idea what your stop loss is or your take profits. That's not a good trade. But if you have like a system and approach, a systematic way to approach the markets that you've been testing and implementing in real life situations for a while now, you are in a really good position to potentially take advantage of this very, very aggressive move that we're going to potentially see. Like always, not financial advice. This is just what we're seeing in the markets and what we're planning on doing, and how we're going to position ourselves to kind of try to take the most out of this opportunity. And that's how we see it right now. So that first leg, definitely, that is the indication that yes, we're in a bear market for sure. But this next leg, in my opinion, is where there's the highest dependability for another leg down, and it's going to be more aggressive. I'll keep everyone updated. As time goes on, I will kind of wind off from just posting these on YouTube, because I do want to provide this opportunity for Performante Premium members kind of only to some degree. I've been talking about it for a very long time, but I do respect them immensely, and I really, really cherish them, being a part of our list and our group and our community and everything that they are involved with. So huge appreciation for them, and that's kind of why we're going to try to wind off a little bit and provide the utmost amount of value we possibly can to our Performante Premium members. So that is the completion of the global macro update. We didn't really get into TVX too much, but we talk about it very often. The dollar moving up a little bit, but like I said, that $103-ish range is going to be the key level that we're wanting to see break in order for the US dollar to see a surge in strength again. We're right now in a bit of a consolidation, but would not be surprised if we saw another move up, breaking the resistance as we can see on the weekly chart. So that is the basic completion of the global macro update. We really hope that you enjoyed this video. If you do have any questions, drop them in the comment section below. I do these live on TikTok and YouTube every weekday, and if you do want to catch these live so you can answer, or so you can ask a question and I can answer, we do them every day in the morning and in the global macro in the afternoon Western time. So definitely check that out, and I'll be going over all the questions on the TikTok, but I will close the global macro update right now. So thank you very much for watching, everyone, and until next time, happy trading.